Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Now joining us for extensive comments is Lael Brainard. We are thrilled that she is here. Young duty Wesleyan in Connecticut and up to Harvard in her public service, and really with a more policy effort. Well, I'm dying to ask you this question. We just had on the show magnificent Stephanie Stancheva out of Harvard. And then I see a Nobel Prize of Claudia Golden out of Harvard. What was it like for you to have the courage to do economics a number of years ago? How lonely was it to be a woman in economics back in the time of Lawrence Summer at the school?
Well, I would say that by the time I got to Harvard, obviously we did have some women on the faculty. Yeah. Claudia Golden arrived while I was there. Susan Collins was there for a period of time. There were some really outstanding young women professors. And you know, it was an exciting time. I care a lot, of course, about how we use economics to affect better outcomes in policy. And so it was just great to be studying with some of the people who have really shaped economic policy making in the preceding decades.
Dr. Brainard, I was laying out the differences between a Clarida and a Brainard, where you look at DSGE and all the mathiness of Clarida and Gertler, and you with a really historic policy effort of getting things done in economics. Color the nature of the uncertainty now that the Fed has to face as we bounce from copper down the most in 40 years to a non-printed India trade agreement. What's the nature of our present uncertainty?
So on the one hand, we know a lot about how tariffs generally affect the economy. We had a little trial run back in 2018 when the first Trump administration imposed tariffs on China, mostly on China, as well as steel and aluminum. We do know that tariffs raise prices. Ultimately, that time between when tariffs are imposed and when you can see it actually in prices varies a great deal, but the last time through, 4 to 6 months. And we also know that tariffs are like a supply shock and they can disrupt the labor market. So we know all of that. What we don't know, and where this uncertainty is so important, is twofold. First of all, we have not seen tariffs at these levels for decades. These are Smoot-Hawley level tariffs in many cases. And so the extent of the changes we just haven't seen. And secondly, of course, the administration is still in the process of telling us what those tariff levels are, and those trade agreements are not yet very firm or very clear.
Lael, what did you take away from the Fed minutes, the Fed news yesterday, the meeting yesterday from Fed Chairman Jay Powell? What was your takeaway?
So the takeaway, I think, was that the large majority of members of the Open Markets Committee want 2 more months of data, and they will get it before the next meeting in September, that they are still quite concerned about potential risk to the upside to inflation, which has been running high over the last few years. And of course, that means they have to be particularly attentive to inflation expectations, but that they're also attentive to potential weakening. And of course, we got the GDP report on the same day. And if you look underneath the hood, there has been quite a bit of moderation in those core domestic components, particularly the consumer, over the first half of the year. So they are balancing those two potential risks, and they really want that additional data before they make a decision to move further potentially on cutting rates.
You know, Lael, we've had a number of guests over the last several days, maybe even weeks, say, boy, this kind of feels like a year ago, where maybe the Fed decided not to move in July when the data suggested maybe they should, and then they were forced to maybe go a little bit more than they wanted to in September. Do you feel like the Fed might be behind the times here a little bit in terms of cutting rates?
So I think there is always that risk that the Federal Reserve, in the effort to get more data to be more certain, waits a little longer than would have been ideal with the benefit of hindsight. But we already were talking about just how much uncertainty the evolving tariff landscape is injecting into the outlook for the dual mandate for both inflation and unemployment. And that explains, I think, why they are stuck waiting.
I've got two things to talk about here, Dr. Brainard, that I think are important. What a nasty op-ed by you in the Washington Post a few weeks ago. It was, the claws were out. Lael Brainard going after the president on the treatment of Chair Powell. Lael Brainard is, if things smoothed out a little bit, even with Trump tweets, even this morning as well, does the industry have Mr. Powell's back?
Well, look, I think what has been surprising to me is to hear the president talk about lowering rates as though it is the Federal Reserve's responsibility to lower rates for U.S. Treasury debt management. And that, of course, is exactly how central banks go wrong in emerging markets like Turkey, when the president, the administration lean on a central bank to prioritize lowering the cost of borrowing to the government. It undermines the inflation control credibility of the central bank. And so for me, of course, what is very important is that the Federal Reserve continue to have that credibility for inflation fighting. Now it's more important than ever, having just come off a period of high inflation and, of course, facing some inflation from tariffs. So that independence is more important than ever.
Lael, I look at the tariff, what's changed since your Washington Post op-ed. I look at the tariff debate. Ernie Tedeschi doing great work at the Budget Lab at Yale. Lael, Yale's a college in New Haven. I don't know if you're familiar with that. But, I look, Lael, at the tariffs now. JP Morgan modeling 18%, clearly Smoot-Hawley, 1933, maybe back to the Gilded Age. Will the president be overcome by events if we see jobless increase, if we see GDP decrease? Do you just assume at some point, like McKinley adjusted, and I think it was 1901, is Trump going to have to adjust to the failure of the magnitude move in tariffs?
Well, it's very hard to say right now. Of course, I don't have any insights into that. But I would say what is clear to me, because I have been listening carefully to the Treasury Secretary and the President, is that they see tariffs as a way of raising revenues, and they have a very aggressive revenue target for tariffs. They want to raise hundreds of billions, $300 billion a year in tariff revenues, which is an order of magnitude larger than what we have seen recently. And that means that tariff rates have to be at those high Smoot-Hawley levels, with the attendant potential effects on the labor market. And we've already seen substantial slowing in the second quarter in terms of underlying private domestic final demand. Consumers look like they are feeling a little bit cautious. We can see that even in today's personal consumption expenditures data, which really was very modest growth. So yes, I do believe there's some risk that by trying to achieve those very aggressive tariff revenue goals, they really are putting a big dampener on what could be a very dynamic and exciting period in American growth.
Lael, the Fed has that dual mandate, of course, of full employment and price stability. Do you think one is taking a precedent over the other these days within the Fed?
Well, I think we heard the chair talk about both sides of the dual mandate yesterday, risks to the upside potentially on inflation, and we see it in this morning's preferred Fed inflation gauge. You see those core goods going back up again after a long period where they had been coming down. But of course, you also see it in the labor market, where private hiring has really ground to a halt. Now, the labor market is in balance, as the chair told everyone yesterday multiple times. The unemployment rate has remained low, and that in part reflects the fact that labor demand is falling at the same time that labor supply is also being constricted on the immigration front. So it remains in balance, but I do worry about downside risks to employment.
Lael Brainard, a young upstart economist up at Harvard. His name is, let me look here, Jason Furman. I think you may be familiar with Jason Furman. I love what he's doing on annualized analysis. Folks, out moments ago on Twitter from Professor Furman driving Ec-10 up at Harvard. 1 month core PCE, 3.1%. 3 months, 2.6%. 6 month annualized, 3.2%. 12 months, 2.9%. I'm sorry, Rick Mishkin and John B. Taylor out at Stanford, those guys may be policy, they're on different pages, they're on the same page. That core PCE inflation, Lael, is too high, isn't it?
Well, the core PCE inflation is too high, and it's going, unfortunately, in the wrong direction. Yeah. That is the bind. So, you know, what we were seeing before a lot of the tariffs started to get imposed was actually finally services inflation were coming down, core goods had already come down, and so core inflation was trending down towards the Fed's target. Now it is detouring. With those core goods lifting it again. And core services actually in the last 2 months were a little stronger than we had previously seen. So it's moving in the wrong direction, and of course that's a concern.
And Paul, I can't emphasize enough the granularity of, these are full-time pros, heavyweights, analyzing the tariff impact, guessing out to Labor Day, guessing out to Christmas, guessing into next year. And the answer is nobody's talking disinflation.
Disinflation. How about the consumer, Lael? How do you, given the backdrops that Tom just outlined here, how do you think the consumer is these days?
Well, we've got some insights into consumers and their feelings about both the economy currently and their expectations through some of the consumer surveys. And of course, a little bit less negative, but still quite negative relative to where it had been before the tariff agenda started rolling out. They seem to be worried that prices just are still too high. And of course, that now is creeping back into core goods, but housing has been a problem for a while. And that goes to the president's concerns, valid concerns, I think, that mortgage rates are quite high and that the housing market is frozen.
Lael, one more thing. I'll be quick here. This is the magic of Twitter if they would get it, if they get their act straightened out. I've got Jason Furman, Steve Ratner, and Ernie Tedeschi back to back to back in my feed. Lael, this is stunning from Ernie Tedeschi, now at Yale. Durable goods have risen by 1.7%. Other than the depths of COVID, that's the strongest 6-month rise since 1987. Does Washington understand that, Lael Brainard?
So I think Ernie is doing a great job pointing out the granular effects, which have to be in part reflecting tariff effects. And when we get pronouncements from the White House, sweeping pronouncements that a country is going to see 25% tariffs, 19% tariffs, you really wonder whether they've had the time and the bandwidth to do the kind of detailed analysis that would allow them to see that some of those tariffs they're imposing are actually going to disadvantage American producers because input prices are going up. It's going to actually not only hurt American consumers, but in many cases, like in U.S. Domestic auto producers, is actually making their supply chains more expensive and will make them less competitive.
This has been fabulous. I got goosebumps right now. It's great. Lael Brainard, thank you so much with Richard Clarida in this hour on our nation's economy and what it means for us. Thank you to 92.9 FM Boston, our Boston News Bureau, for bringing us Dr. Brainard this morning.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
We are honored to have with us Richard Clarida, always with Columbia University, with PIMCO, as well, the former vice chairman of the Fed. Ian Lincoln at Bank of Montreal, the iconic Bank of Canada, just published, and he said, I'm sorry, every inflation series is ticking up. Do we see tariffs in the minutia of price change already? Do we see tariffs now?
Sure, they're starting to show up to some extent in the inflation data, in particular in those sectors exposed to tariff. Goods prices are moving up. The overall indexes are coming in more or less in line with expectations because services inflation continues to fall.
So if you're the Fed,
yeah,
what did you hear yesterday from our chairman yesterday? He sounded a little bit more hawkish than maybe the statement. I don't know.
Harry Truman, I think, once said he wanted to meet the one-armed economist because he kept getting on the one hand on the other hand. I think that's what we got yesterday from Chair Powell. Very balanced. I think the revealing moment was when he was asked by a reporter about whether or not the dots at the June meeting were indicative of where the committee was, where they showed 2 cuts this year. He basically said, look, that was 6 weeks ago. We're not paying attention to that. So he clearly, I think, came in with the goal of giving himself and the committee optionality in September to pause or to cut. And I think he achieved that for sure.
I got to get this out of the way. I have to ask, have you been contacted by the Trump administration about future employment in our central bank?
I have not.
Okay, we're waiting on it. There was, I asked Glenn Hubbard the same question and got the same silence treatment as well. In your work, and folks, this is wicked fancy mathematics called dynamic stochastic general equilibrium theorem. Uncertainty is outside the system. It's what we call exogenous. Our listeners, our viewers are living endogenous uncertainty right now with all of these shocks to the system led by tariffs. How do you color the uncertainty that the PhDs at the Fed face?
It is elevated. I think perhaps less elevated than it may have been after Liberation Day. I think, in particular, we have a better sense, and firms have a better sense of where we're going to end up in terms of the new trade regime. And importantly, also, we now sort of know the parameters of fiscal policy, tariff revenue, the deals that are being cut in terms of investment in the U.S. So there is uncertainty, but I think it's moving in both directions for the economy. Do we have clarity? I mean, I look at the Yale Budget Lab, Ernie Tedeschi, and that crew. Yesterday, Bob Michael modeling 18% blended work at J.P. Morgan, maybe up to 20% as well. How do people like you that have actually studied the history give us, I like to say this, Hubert Heaver tariffs? We're back to the 30s. We're back to FDR and some, you look at the series, we're back late McKinley. How do you process the magnitude change in tariffs? Well, sure. We haven't seen trade policy like this in a very long time. I think right now, I would say the economy's shown good resilience so far, both in the labor market and on the GDP side. But I think anyone who pretends to have a precise model or estimate, but I think importantly, what's going on here, Tom, is the Trump folks are really trying to change the trading regime, and it's early days in that. But I think that's an important part of the story as well.
So, Richard, we had 2 Fed board governors dissented yesterday.
Both very good friends of mine and former colleagues.
So Fed people tell me that's kind of something. We should pay attention to that. What did you make of it?
It's the first time, I think, in 30 plus years that two governors have dissented.
Back to
Reserve Bank presidents dissent more frequently. Both Chris Waller and Mickey Bowman, I think, before the meeting indicated that was going to be their preference. And I think that I'm sure they came into the meeting with sound and reasonable arguments for beginning rate cuts right now. We'll probably hear from them after the blackout is over as well. But Chair Powell also acknowledged that he thought it was a good discussion at the committee.
Do they negotiate dissents? Like if there's someone who's the third dissent, do they say, no, you can wait till the next meeting? Come on. Not at the table in the Eccles building. Wait, the table's under construction. I forgot right now. But is there a discussion within the propriety of American, we're all on the same page, economics, that we almost negotiate who and who does not dissent?
I wouldn't call it a negotiation. What does happen, and I think this happened under Bernanke and Yellen as well, but certainly during my time at the Powell Fed, the chair before each meeting had individual conversations with all 18 people.
Interesting.
And so no one gets blindsided going into the meeting about the views on the outlook. So
this is original. This goes back to Larry Myers and Greenspan. In that meeting, is it a courtesy that you tell the chairman where you're heading?
Again, those conversations were typically bilateral with the chair. But
Paul, Clarida's really unhappy he showed up today.
No. During my time there, the chair did have individual conversations with all 18 folks. Obviously, there were 19 total. And the purpose of those conversations was so that both sides had a sense of where policymakers were heading going into the meeting. And then during the meeting, which go on for a day and a half, sometimes minds change as well during the meeting. But at least going into the meeting, people all have a sense of where other folks are.
I tell you, what's changed just in the last couple of days, Richard, is I think after yesterday's discussion, the market's kind of pulling back a little bit on the 2 rate cuts this year. I don't know, between now and September, the Fed's going to get some more inflation data. They're going to get some more labor market data.
Yeah.
Are they just going to wait for that, I guess? I mean, that's being data dependent, I guess, right?
The chair indicated that yesterday. I think that would make sense. He'll also have another bite at the communications apple, to mix metaphors, at Jackson Hole in 3 weeks. And not always, but oftentimes the chairs do use Jackson Hole as a way to preview the September meeting. So perhaps another motivation for the two-handed economist yesterday from Jay Powell is I'll have the stage to himself at the end of the month.
For all of you on your commute across the nation, a wonderful treat today within the technology earnings. Lael Brainard scheduled to be with us here later on in this half hour. Of course, all of her work with our central bank. And now Richard Clarida with us with PIMCO, the former vice chairman. I hate Torsten Slok because on a Wednesday, he sends me an email from Apollo Global Management with 6-7 things to read. And usually the top ones are little light, quick reads. Here's what he sends today. Clarida, post-pandemic global inflation, disinflation, and central bank policy responses. It goes on. It's like a movie. It's got a British movie. It's got a long title.
Yeah.
NBER, a paper you just published with your thoughts on 21 and 22. Take this important paper that Torsten Slok mentions and bring it forward to the present day policymaking.
I'll give you the quick elevator version.
Please.
Global surge in inflation. Where did it come from? How do we think about it? And what are the lessons learned? And the basic point of that paper is essentially to summarize a lot of sort of one-stop shopping. If you don't read 50 papers, you can read my summary of the papers. And the basic story is the inflation came from 3 factors. A once-in-a-century pandemic, which led to a shock to supply, triggered a fiscal and monetary policy response. And then on top of that, of course, you had the Russia invasion of Ukraine. Policy reacted.
Right.
Inflation came down. central banks were confident enough to cut rates. So I think the lessons learned to me is once in a century pandemic shocks are very challenging for policy. And on the other side of it, inflation expectations are anchored, and that's where we are.
Peter Orszag at Lazard now, running the shop at Lazard and also working at Brookings, really emphasizes supply side shocks that we had. Are we there now? Is the tariff uncertainty now one big supply side shock? I mean, witness copper, biggest drop in 40 years yesterday.
Sure. The other thing I'd like to emphasize as well is the unemployment rate is low, and that is great. It's at a very low historical level, but there's still room for the labor market to expand in terms of labor force participation. It's about a point below where it was decades ago, and especially among men, prime age males. So a low unemployment rate is good, but the economy's capacity depends upon labor force as well. And I think there's still room to run there.
President Trump continues his pressure on this Federal Reserve, saying that they should be cutting rates. But we have folks that we really respect come through the studio that say the Fed is behind again. It really needs to cut rates. I mean, whether you look at real rents or whatever, I mean, if you look at the real-time data, it's already there. The conditions are already there to cut rates. How do you think about that?
I think a straight reading of sort of standard monetary policy rules, including the ones I worked on with Gertler and Galley, for a pretty wide range of assumptions would indicate that there's some room to cut rates from current levels. The details will depend on the model and your views of inflation, but anywhere in the range of, of 50 to 75 basis points from here, under the view that Waller and Bowman have expressed that the tariffs are not really an inflation shock, they're a price level shock. And so I think that is the case. And I think Chair Powell himself, a month or so ago, indicated that but for the trade policy uncertainty, they would probably be cutting rates now.
But this is important, Richard. I really can't say enough. We are slaves to trend.
Oh, sure.
If we cut rates, it establishes a vector that we must follow. Why in God, I'm speaking for President Trump now. Good morning, Mr. President. If you'd like to call in, we'd love to talk to you. Why in God's name can we just announce, let's just do a one-off rate cut and see where we stand in September or end of October? Why are we slaves to trend?
I think that's the $64 billion question. And it reflects the evolution in monetary policy. Yes. If you go back to when, Tom, you and I started our careers in the 80s with Volcker, Volcker would never give you an indication of where rates were going to be in 6 months or 6 years. It was one meeting at a time. And for the first half of Greenspan, it was one meeting at a time.
Then what happened? This is really important, folks.
Well, two things happened. The academic literature, to which I contributed, said there can be benefits to providing guidance on the rate path. And so I think policymakers fell in love with that idea. They doubled down on it when we hit the zero lower bound, and it made sense to do that. But one of the points I make in the paper that you nicely plugged, Tom, is that monetary policy is not immune from the laws of economics. There are benefits and costs to decisions, and there are benefits and costs and diminishing returns. And I think you raise a very good point. Could be in a different world if basically the Fed and other central banks said, there's a lot of uncertainty. We're going to do one meeting at a time.
Let me cut to the chase. Are we live in physics envy, where we have a lot of fancy people, including Clarida's math folks, is world class. I can't tie his shoelaces. I can't tie your shoelaces.
I'm a dinosaur.
Okay, Gertler's not a dinosaur. You're a dinosaur. But are we slaves to the certitude of inertial force, where we set up a vector and we've got a momentum of some calculable? Are you kidding me? We can't do inertial force.
I wouldn't say we're slaves, but that mindset has a very, very powerful hold on a lot of thinking in markets and in policy making.
Paul, get one more question in.
I'm going to the $1 million cowboy bar out west somewhere next month. What should the Fed chairman say in Jackson Hole? Should he change his tune? Should he try to set up the market for September? What do you think we will hear when Tom's out there in the $1 million cowboy bar?
I think he's probably going to devote his remarks to previewing or laying out what they've decided in terms of the their framework. And I think what he will do is embrace more or less traditional inflation targeting, saying we're not close to the zero bound now, and policy will act symmetrically. In terms of what he does in terms of the next meeting in September or the rest of the year, I think it will depend in part on the data that we get between now and then. And it will depend as well on his assessment of his understanding of the current trade regime.
Right.
Yep.
I will read your paper, and I have can I do a report card on a 3x5 card?
Yes, exactly.
Richard Clarida, thank you so much.
Thank you.
Absolutely brilliant, folks. That was an absolute clinic on some of the trends, the physics, the background of how these officials think. Richard Clarida, the former vice chairman of the Fed.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Amir Pandit joins us from JP Morgan, where they're looking at the tech juggernaut from 60,000 feet. How does tech in America, in this clear, I'm going to take the ego dash, exceptionalism, how does it affect an overall investment outlook?
When we think about the history of U.S. exceptionalism over the last, call it decade, 15 years, it's been about economic exceptionalism. When we think about this miracle of high growth, relatively low inflation, relatively low interest rates as well. But it's also been about corporate exceptionalism. And going forward, we may have some deterioration in some of that economic exceptionalism, but certainly you still have that corporate exceptionalism, and it's rebirthing itself. It's just reviving itself time after time in 2023 with the AI revolution, but also much before that in the first phase of some of these companies. So it has been spectacular to watch some of these very mature companies reinvent themselves and grow profits as they have.
I just plugged into the total return index, 555 on Microsoft, which is where it's going to open, I guess. Last 10 years, 29.9% per year.
And I'm looking at it today, and I'm like, how do you not own it even today?
I don't own it, thank you. Triple leveraged all cash. Mira put me in it.
But you sleep like a baby, all good. Mira, what have we seen from earnings? What have you guys seen from earnings so far? And what do you think the market needs to see from earnings this cycle?
Earnings have been pretty healthy, but also remember the fact that estimates for earnings were basically cut in half for this quarter since the beginning of the second quarter and over the course there. So the bar was relatively low. We're seeing earnings surpass that. You are seeing the Mag 7, of course, so far blowing the lights out on earnings, expected to contribute about 2/3 overall to earnings growth over the course of this quarter, but that should broaden out over the next couple of quarters. So the good news is that we are not only hanging our hat on Mag 7 profits. The across the board story is improving incrementally. But when you think about how that passes through to markets, the Mag 7 are driving about 1/3 of the returns in markets. So the market does not demand that the Mag 7 continue to post these types of profits. When I think about it from a broader allocation perspective in terms of what clients do and don't own, we should also remember that given the comeback in the Mag 7 itself, you probably already own a lot. So it's not necessarily requiring us to double down on it. They're names that you want to have in your portfolio, but also think about broadening out beyond that, given the fact that this year, for the first time in a while, we've got choices.
Well, one of the choices is, and we saw people make this choice earlier in the year, is they move money out of the U.S. into rest of world, maybe even European equities, for example. How did you guys view that kind of trend? And did you guys participate?
We did see investors, at least at a headline level, more interested outside of the US, but you also didn't necessarily see investors actually selling the US. You still have foreign investors owning about 1/4 of the treasury market and about 20% of the equity market. And you also see Americans and foreigners doubling down, not only the retail segment, but also increasingly the institutional segment. So I don't think that sell America narrative is intact. However, I do think that people are putting that incremental dollar towards some of the other more diversified opportunities across the board internationally. And it's not just the dollar. We're seeing the dollar move a little bit higher, as Tom pointed out, and yet international equities have survived on a number of different catalysts.
Bob Michael stopped me cold yesterday. It was a single sentence of the Fed Decides show. Feroli and Kasman are modeling now, as Ernie Tedeschi at Yale Budget Lab, 18% tariffs back to 33, 34. And Bob even goes up to 20%, which to me is unimaginable. Folks, this is like McKinley tariffs in the Gilded Age. If we get that, what happens to an investment strategy in America?
We do have to be mindful that if we get that, it's probably going to result in higher inflation and slower growth. But we also have a little bit of a wrench in the works here when we think about where we get to in the beginning of next year, in that we're going to start to see the impacts of fiscal stimulus when it comes to some of those tax cuts. Some of them are extensions, but there are some sweeteners in there that are going to add some fiscal stimulus to the economy. That could potentially keep inflation a little bit higher. It could also boost growth.
Do rate cuts come to the rescue? Are rate cuts just to normalize, or can they actually add on to the stimulus of the huge fiscal bill?
They could. I'm not sure that rate cuts are actually as relevant when we think about the fact that over the last couple of years, you've actually had even higher interest rates and you've had 20+% markets. Even outside of the Mag 7, the S&P was up 8%, 10% over the last 2 years, respectively. So we don't need rate cuts to save the market. I mean, the market doesn't look like it needs any saving at all.
Have you been in the new building?
Not yet. I've seen it. You can see in through the windows from the building across the street.
Very exciting.
Very exciting.
It's just, within all that's going on in New York City and this tragedy, it's just great to see the leadership at JP Morgan and Citadel and others on Park Avenue. I really can't say enough about it. Mir Pandit, thank you so much. Global market strategist, JP Morgan Investment Management.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.
Now we go ever stronger. Mark Lehman is with Citizens JMP Securities. He is definitive on the culture of San Francisco and Silicon Valley. This goes way back to Montgomery and other names from the past. This is a guy with sell side, get out the Excel spreadsheet cred, but also done M&A. I want to talk about picking up the pieces off of First Republic, May of 2023. You've been intimately involved, not so much in the details, but has San Francisco and Silicon Valley recovered from that debacle?
Recovering. It's a good theme with what we talked about today, and we'll talk about with Meta, because it's about AI. And it starts with the election we had last year and Daniel Lurie becoming mayor. So a year ago, the mayor, London Breed, had about a 30% positive and a 70% negative. Today, Daniel Lurie is a 70% positive and a 30% negative. You probably couldn't get a 70% positive on anything today.
You mentioned Frank Cottrone yesterday. Yeah. This guy is like Frank. Yep. You're more qualified than anybody I know to give me the x-axis on AI. Is AI equivalent to anything in the past? And how far out do you see this, as I'm speaking as an amateur, this boom?
I hate to say it because the stocks have moved so much, but it's early. And Meta is a perfect example of that. Some of the things that they're starting to work on and starting to see are showing in the numbers, but it's really just the beginning. And I'll give you one example, Tom. They even talked about some of the using large language models for the first time. And as you know, we've been talking about those for a bit, but they're starting to use those for some of their offerings. And so we're already seeing the numbers show up. We're already seeing what they're doing with CapEx, but it's showing up in the numbers already, and we're just at the beginning. So as much as these stocks have run and as much as we've seen great gains in the stock market, I hate to say this because it's going to spook some people, we may be early.
Interesting. And Mark, I mean, you're responsible for the state of California, the business, investment banking business for citizens in California. That's like one of the biggest economies in the world. Talk to us about California writ large. Because we've heard so many stories about people leaving New York, people leaving California for Texas and Florida and so on. So how is the economy in California?
So it's gone from the fifth biggest economy in the world to the fourth biggest.
Wow.
Citizens has now a major footprint there, where before it had a minor footprint. As you know, they bought my predecessor firm, JMP, but they've gone in a variety of markets, whether it's San Francisco, Silicon Valley, Orange County, Los Angeles, San Diego. Citizens now has a footprint in private banking. And some of the halo that First Republic had we've been fortunate to garner, because we've just hired some of these people who are really, how many people say they love their bank? And yet people at First Republic love their bank. And we've been able to garner some of that halo because it's all about service and it's all about coordinating. And we're coordinating across the platform. So of our mid-tier peers, we're coordinating across a private bank, an investment bank, a commercial, and a consumer bank.
How will Silicon Valley defend against Lord Dell down in Texas and Texas building out? They're doing what, the New York Stock Exchange? In Texas or
Y'all Street.
Y'all Street?
Yeah.
What are you watching, Landman or
that's
something?
what I am.
How does California strategically defend against the Dell juggernaut in Texas?
I think it's a big pie. I think we have some things going for us. Obviously, we are, as I'd like to say, the Golden Gate Bridge isn't leaving. Cal's not leaving. Stanford's probably not leaving.
So it's the educational foundation.
When I hear everybody's leaving San Francisco, I just have my best guess is Cal and Stanford are staying. And yet, the talent and the dollars that are being spent on AI, you can look at the statistics, the dollars that are being spent, 40% in San Francisco. That's a big number.
The horrific tragedy in New York City we're living in the last 72 hours with Blackstone, their commitment before all of this horror to Western Pennsylvania is just absolutely extraordinary. Again, Carnegie Mellon, University of Pittsburgh, and that. Are we going to see a greater at the margin cash commitment into Silicon Valley?
I think what you're going to see is a public-private partnership, and San Francisco is leading that. Like I said at the top, Daniel Lurie and the business leaders in San Francisco are committed to finding ways to exploit the talent base that we have. Some of the ills that we have are being fixed, and I think there's nothing we like more in this country to kind of denigrate things, but there's nothing we like even greater than that, than a resurrection story. And I think you're seeing that real time in San Francisco. And I think that public-private partnership is the most important thing.
Mark, we heard from some of the big banks reported earnings last week. We heard some pretty positive rhetoric from the Jamie Dimons of the world, the Brian Moynihans of the world, talking about the big global capital markets business, global banking business. How are you seeing it in the mid-market in California?
It's definitely picking up. I think you're seeing the first signs of a resurrection of the IPO market. It has not been like we saw in 2021, and I will not predict that. But you're going to see in the back half of this year a bunch of tech companies and a bunch of...
And we saw Figma price last night.
Exactly, and you're going to see several after Labor Day, and you're going to see more going into 2026.
Tell us about electric generation. There's an angst about it, I think, nationwide. I'll say in Virginia, leading the way. But is there going to be a power suck where the lights don't go on in the Golden Gate Bridge because of all the AI wrapped around the San Francisco Giants and Mark Yastrzemski?
Not going 2-8 in the post All-Star break. They're 2-8 after the All-Star break.
But it's painful.
It is painful.
They traded with the Red Sox.
I did, and I'm not sure Devers is happy with his new home, but we'll have to see.
Wanted to remind you of that. Thank you.
But my hunch is no. I think there's going to be the kind of innovation that we're seeing in technology you're going to see in power generation, and it is a land grab right now, right. And the war on talent for that is real. With the kind of AI purchase that we've seen Meta make and Microsoft make.
Can we go back to Mark Lehman, old school? Forget about this executive M&A Bank Act and all that. The cash use of these juggernauts that we all own, we're all living. Do they understand they have to deploy cash to shareholders within buybacks, or as Paul mentions, always dividend growth?
If you're talking about the big seven or big eight, I think, like we said, it is kind of a war on talent right now. And when you see the headlines that Meta got for spending $15 billion for half a company, they really spent $15 billion on a bunch of talent. And it barely is, it's not 1% of the company, right? So it looks like an enormous number and an enormous bet, but it's really not. And when you see the kind of returns that the companies get on their investments, and their investments are in people, I think right now they think a bigger investment is in that race. And it is a race. And there's 4 or 5 incumbents, and then there's obviously OpenAI, which we saw their valuation recently, and others, but there aren't going to be 20 of these. And there's one other thing that I think is really important to note, is that there are a couple of companies that have resurrected. I have said for a very long time, there's only 2 tech companies who reinvented themselves. It's Apple and Microsoft. But look at the market cap ascent of Oracle. Look at the market cap ascent of IBM. And these companies were left for dead, basically. Obviously, not Oracle.
IBM's getting their act together.
They really are. So when it's about leadership, and it's about talent, and it's about drive, in future.
20 seconds. Intel, help us.
NVIDIA's market cap's going to go up more than Intel, three Intels today. And I hate to be pessimistic. It's really hard to find a path for that.
I got goosebumps. This week of technology. Mark Lehman with us, CEO of Citizens JMP. That's a great brief before we speak with Anurag Rana.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
This is the way we roll. We got Mark Lehman with us here with Citizens JMP and Anurag Rana. On the physics of this AI moment. He's with Bloomberg Intelligence and has been absolutely dead on have courage for a long tail of AI excellence. Anurag, after what we saw yesterday, I want you to frame out capital spending for 26, 27, and even 28. Is it a linear expansion? Does it accelerate into the coming years? Or is this as good as it gets?
So at least for the next 2 years, we think the numbers are going to go up. The rate of growth is going to slow down, but it's tough to call out 27 and 28 because right now we have just started to see the benefits of all these investments that, for example, Microsoft has made. So I think a lot depends on the pace of adoption and more so on the enterprise side to see what 27 and 28 looks like. But at this point, we feel very confident about 25 and 26.
So, for Microsoft, give us the 2 or 3 things that the bulls are really hanging their hat on here. Again, looks like we're going to hit $4 trillion market cap here today.
So, Paul, the simple, basics is when a company's size gets bigger, the growth rate stops or slows down. In the Microsoft's case, you could see that growth in Azure is accelerating. This is now a $75 billion business as of the end of last quarter. So, in that case, when you see growth rate in the 30s accelerating, that basically shows that the AI adoption rate is picking up, and people just assume that this is just the beginning of the adoption curve. Right now, all we are seeing is the infrastructure spending, and that's the benefit everybody's seeing, whether it's NVIDIA or Dell servers, etc. But now what we're seeing is adoption rate on the cloud side, and I think that is really what is exciting a lot of people out there.
So, Anurag, when we take a look at Microsoft here, what percentage of the cloud and AI do you feel like is their market share versus some of the competitors? Because we still have to hear from Amazon.
Yeah. So when you look at just the cloud infrastructure side, they are the second biggest player after Amazon. Amazon's run rate is well over 100 billion, but Amazon's growing in the let's say around the 18 to 20% range. Microsoft now is showing that they're growing, 38, 39%. That's a very big difference between the two. So just imagine a $75 billion business growing in the mid 30s. And that's because they have that direct relationship with OpenAI where they're getting the direct benefit of you and me using more ChatGPT.
Anurag, let's do a 2-part question. I'll get to Apple on the back end of this. Color out the nature of their businesses. Dan Ives is very big that Microsoft is the enterprise cloud person. What is Amazon? What is Oracle and the rest? What's the character of those cloud businesses?
I think that's probably one of the most important questions for people to think about it right now. When you look at somebody like an Oracle, they are, I would say, primarily an infrastructure, AI infrastructure player at this point, which means you want to go there, you want to rent out the GPUs, and you are training your models. Microsoft has basically said that's the business they're not so keen on. They really want to rent out capacity for training to others, but they are really on the inference side, which is when an application is running, they want to run that application because they eventually want to grow with that application. We think that's a more high value product.
So then bring it to Apple this afternoon. Apple and Google have a search agreement. Do you just assume there's going to be an announcement that Google Gemini becomes part of the Apple family? What do you see, Anurag, as salvation for Apple's AI miss?
So, Tom, as far as I'm concerned, that is the biggest overhang on the stock that nobody talks about. That 20 billion odd payment that comes from Google is very high margin business, adds really to the free cash flow and the valuation of the company. If they ever make a deal on that, I think it will be good for the company. It'll be good for the stock. But one of the good things Mark Gurman has reported is Apple's ready to go out and partner with other companies to get their AI into their ecosystem. I think once they do that, that's another overhang that goes away from the stock.
Paul wants to get in here. Let me be quick. What are they waiting for?
Good call.
I think it's a little bit of they take their time in making these decisions. They are not, they never do things in haste. And I think that speaks to the way they treat their, user base. They want to protect their privacy. They want to make sure things are fine for them. So again, I'm not going to get rid of my phone just because the AI is a little bit slow or I can't make some pictures, but I think it's going to come over the next 12 months.
That kind of goes to my point, Anurag. Every time I hear you and other smart people like Mandeep Singh talk about AI in the context of Amazon or Microsoft, it just, the initial question is, what about Apple? So I kind of feel like, all right, they don't have to be first, but boy, they just feel like they're getting every single day farther and farther behind. I kind of feel like time is of the essence for them to announce something major.
Yeah, I completely agree with you. But at the same time, this is a company that controls probably the most important distribution system for consumers out there. People will stick to the phone no matter what. If they get it wrong, Paul, that really makes a huge difference for them. So this is why they're taking their time. They're using multiple models to figure out what's best for them.
Anurag, just to keep up with you, this guy's physics, University of Delhi,
I know, that's solid.
It's amazing.
They know what they're doing.
Anurag, I did MSFT equity. Tom Secunda said, Tom, you got to do more terminal.
You got to do more terminal
Folks,
talk.
stay with me on this. 2 hands on the steering wheel. Okay, Anurag, MSFT equity, AAPL equity, HS. I did a ratio spread analysis, and Apple's failing off of Microsoft by 2 standard deviations, which it's ginormous. Where's the urgency in Cupertino?
Well, think about it this way. Microsoft sales last night grew at 15%. Apple's going to grow at 5%. I've been debating. I always never understood why there was always valuations were at parity at that point. Now we are coming to a point when the valuation shows the growth potential of Microsoft. Imagine a company this size growing at 15%. That's pretty big. Apple, 6-7% max at the best at this point. If they come up with a new iPhone 17, maybe it goes to 7 or 8. But that's where it ends, frankly. It doesn't go in double digits. Under no circumstances can I see Apple growing in double digits.
Anurag, 30 seconds. Is Elon in this discussion?
Yes, but the question I always wonder whether it's Elon or Meta is how are they going to monetize their large language models? Now, this is where Microsoft really has the biggest distribution army in the enterprise world. So they will stick their AI products across every enterprise out there, even if it's not the best. I do not know how the others are going to monetize that.
Is this great, Mark Lehman?
I know.
Back to back with Anurag Rana.
Yep.
Mandeep's in the on deck circle.
Yeah, he is. He's on the subway. He's coming in.
Is that how he rolls?
Yes. Yeah, he's coming in.
Okay, very good. Anurag, thank you so much. Anurag Rana, now there with great seats for the Chicago Cubs.
Oh yeah,
it's unbelievable.
It's a burgeoning tech hub, Chicago.
It is a tech hub. Anurag Rana, thank you so much. That was fascinating. On the different AIs. I don't pretend to understand it.
This is the Bloomberg Surveillance Podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.